everybody talks about how easy it is to make money in the stock market and that if you can be patient and invest for 20, 30 or 50 years, you're going to become a millionaire. But only a few people take inflation and other factors into account. And since I always want to deliver facts and not opinions, for this video I upgraded my compound interest calculator to a new level to take account of all different factors like inflation, contribution increases, expenses increases, and this file that I'm going to use for this video is available to all of you for free through a link in the description below. So drop a beautiful like and grab your free calculator at the end of this video. By the way, the most important part of this video is where I explain why investing is the best thing regardless of inflation. So I suggest you watch the whole video until the end. My name is Rick, your Italian investor and twin of Mano Ginobili, and after today's video you'll be able to calculate exactly how much of your net worth will be eaten by inflation, how to get to your financial goal, and how long it will take you to get there. Let's start with a simple case. Mark is 35. He has $35,000 saved in the bank, and with his income is able to save up to $500 per month. Considering future salary increases, he thinks he's going to be able to increase his deposits for his investments every year by 5%. So first year $500 per month, second year $525 per month, and so on. He just subscribed to my channel and he knows that by investing in broad-based index funds like the total stock market or the S&P 500, assuming that the market will grow as it did in the last 100 years, he's going to achieve an average growth of 10% per year. Currently, he spends around $40,000 per year, but he doesn't know how much he will spend in the future. So if we start entering his data in the tool, we have $35,000 initial invested capital, $500 monthly contribution, an increase of 5% per year in his contribution, and since he's 35 and wants to retire by 60, his investment horizon is 25 years. The yearly returns he expects are 10% per year, and the average inflation rate is 3%. His yearly expenses are $40,000 now, which in 25 years from now, when he retires, because of inflation, are going to grow to $83,751. So according to the 4% rule, the tool tells us that Mark, 25 years from now, is going to need around 2.1 million portfolio in order to retire and be able to safely withdraw this $83,000 every year without ever running out of money. This equals to an inflation-adjusted portfolio of 1 million. Now, for those of you who might be confused, the portfolio needs to be 2,093,000, but since it's 25 years from now, in 25 years, because of inflation, those 2.1 million are going to have the same buying power as a million today. That's what inflation-adjusted values are for. Obviously, even less than 2.1 million could be already enough, considering that the market returns an average of 10%, not 4%. But if you want to know why we need to be so conservative, you can check out this video where I explain exactly how the 4% rule works. So here's the first reality check for our Mark, because first we thought, if my expenses now are $40,000 and I use the 4% rule, multiplying 40,000 times 25, I get 1 million. So 1 million should be enough. But now he learned that he needs to consider the future living expenses, not the current ones. Or in other words, you need to achieve the million as inflation-adjusted value. That means that his real portfolio must be even more. So he says, okay, let's try to reach 2.1 million, or in other words, 1 million inflation adjusted. He writes here the new goal, $1 million inflation adjusted, and the tool says that with these contributions, he's going to need 30 years. Here comes the second reality check, because Mark was hoping to retire at 60 in 25 years. But investing for 25 years is only going to achieve a $1,417,000 portfolio, which in 25 years is going to be like $677,000 today, losing 52% of its value in inflation. So now he has two choices. Either he delays his retirement or he increases his monthly investments. Since he can't invest more than $500, he accepts to invest 5 years longer, so 30 years instead of 25. And here we go. In 30 years, investing like this, he's going to achieve a portfolio of $2,475,972, which after losing a huge 58.8% buying power because of inflation, is going to be worth in the future like $1 million today. But this way he achieved his goal. In 30 years, with $2.5 million in his account, he can safely withdraw $97,000 per year, and it will be just like if now he had $1 million and withdrew $40,000. Now I want to move your attention to this graph because this shows you exactly how much of the portfolio value is actually lost because of inflation. For instance, in Mark's case, the portfolio in 30 years is going to be roughly 2.5 million, which is the whole bar. But the yellow part and the red part are going to be the value lost because of inflation. In fact, $1.2 million is going to be the value loss of his returns because of inflation, and $255,000 is going to be the value loss on his deposits, bringing the total value loss because of inflation to $1.455 million, or 58.8% of the total portfolio. So his portfolio has grown 471% in 30 years compared to the $433,000 that he invested over his lifetime. But the real growth, inflation adjusted, is just 135%. This poses the question if it's worth it at all to invest in a stock market, and even though many people use inflation to argue that investing is useless, everything I'll tell you today will make you realize that instead, it's far from being useless, and instead, investing is even more important because of inflation. But before telling you all this, I want to show you how inflation behaves and how much it's going to take away from your portfolio depending on different factors. Now, we've seen that for Mark, our investor, with $500 per month and 30 years investing, inflation is going to eat 58.8% of the total portfolio value. Obviously, the effect of the inflation has to do with time. So whatever you do that reduces the time that you need to achieve your financial goal is going to help you with that. For example, if Mark invests for 20 years, inflation will consume 44.6% of the portfolio. Still a huge sum, but less. To push it to the extreme, let's say that you invest for 50 years. For example, you start when you're 18 and you want to invest until you're 68. In 50 years, inflation really hits us hard. 77% of the total value of our portfolio is consumed by inflation. This means that you're going to have a $20.4 million portfolio, but 50 years from now, they're going to be worth like $4.6 million today. 15.7 million is lost value due to the inflation. And if you see from the graph, the red and the yellow parts are all lost value because only the small blue here, which is your deposits, and the green here, which is the return of the inflation, are going to be left. Now, this is actually the argument that people use to say that investing is useless. In fact, I decided to develop my tool like this because I found a page on the internet that is called investingwontmakeyourich.com. This guy shows how inflation over time is a higher and higher weight, and therefore investing won't make you rich. I seem to understand that this guy is Italian, and that's why he uses 26% as tax rate. But in many countries, and above all if you're American, the tax advantages should always be considered. If you look at the tax brackets for long-term capital gains, namely for investments that you held for at least 1 year, you notice that if you don't sell hundreds of thousands of stocks every year, you're going to actually just pay 0% on most of what you sell. The yearly income that goes over $64,000 up to $566,000 is then taxed on a return by 15%, if you ever sell so much in a single year. Moreover, these brackets are increased every year to consider inflation. In fact, as you can see, in 2024, they were lower than now. This is the reason why I haven't considered taxes in my tool. So if you use this platform, consider the tax advantages or just write 0 in the capital gains tax. Anyway, there is some truth in what this guy says. So to be fair, let's see what he writes and comment on it. All right, why this website? Because I'm seeing the personal finance and investment topics booming on YouTube, where random dudes deceive people by making them believe they can become millionaires by just picking the right stocks and building the right portfolio, when in reality they only waste time and money. Alright, to this point I have to say, I understand the frustration. YouTube is full of people that just tell you how you're going to become a millionaire with 0 effort by investing $200 a month, and they don't consider half of what actually needs to be considered. That's why in my videos I try to be as transparent as possible, and for example in the compound interest calculator that I showed you before, I have all these factors taken into account, like inflation. Why investing won't make you rich? Mainly because of 2 factors. Low starting capital, you need at least $1 million invested in a low-risk financial instrument to just get the basic income of a normal 9-to-5 job. Yes, that's true, you need at least 1 million. But you know how cool it is to get the income of a normal 9-to-5 job without working a 9-to-5? Come on. And second, low returns, because the higher the risk, the higher the potential loss. This is also correct. In fact, when I hear people that have 60% of their portfolio on semiconductor ETFs or AI ETFs or in crypto, I'm always like, oh, careful there. So then he says, what are the alternatives? Invest in a higher education. True, I always say that if you can use $1,000 to improve your education, open new doors, or even just get a salary increase, it's going to return more than the stock market in the future. And then he says, start your own business. As we say in Italian, grazie al cazzo. Obviously, your own business has a much higher potential, but also a much higher risk. You see an Alex Hormozi that became a multi-millionaire, but you don't see the thousands of people that go bankrupt every year and are left with debts. Anyway, obviously, if you have what it takes to be an entrepreneur, you should definitely do it and invest your money in it. Now, I want to tell you why, for me, investing is still the second best thing you can do with your money besides starting your own business. And assuming you don't want the stress of a business, it's likely your best choice going forward. If we go back to my tool and we assume we invest for 50 years, you've seen that 77% of the value is lost due to inflation. So this is the superficial level of argumentation that people use when they tell you that investing is useless or won't make you rich. They show you a graph like this and they say, look, the yellow and the red parts are what you lose because of inflation, so what's left is nothing. But let's try to consider what really happens here. The second graph here shows how the portfolio grows in 50 years, the red line with $35 million, its value inflation adjusted, the yellow line with roughly 8 million, and your deposits, basically what you paid from your pocket, which is the blue line and it's around 2.5 million. And the first mistake that they make is they say, look, the yellow line is your portfolio after inflation and it's not so much more than the blue line, which is your investments. This is like comparing apples and oranges. You compare your deposits to an inflation-adjusted portfolio. But if you don't invest, what's the alternative? Either you keep your money in the bank and the deposits are also going to be subjected to the same inflation, or you spend them because you think investing is useless, and then in retirement, not only you don't have the inflation-adjusted portfolio, but you have nothing. So it's actually more correct to compare only inflation-adjusted data. And this is what the third table is for. So if your monthly deposits are put to work, after 50 years, they turn into over $8 million inflation-adjusted. Don't forget, inflation adjusted, because actually they are 36 million. While what is their value if instead of putting them to work, you would have just saved them? $581,000. You see the difference, right? Another example, let's say that you don't invest every month, so the monthly contribution is zero, but you have a large sum, let's say $500,000. After 50 years, you have over $70 million in your portfolio, which, yes, loses 77% of their value to inflation. So it's like if you had today a portfolio of 16.5 million, but what is the alternative? If you just keep your $500,000 in a bank, after 50 years, it's become $114,000 inflation adjusted. You can buy anything with it. So this is the first consideration. Inflation, it's a big percentage of your value. True. But it does it whether or not you invest. If you invest, you fight inflation and you even get out in positive and rich. If you don't invest, whatever you sacrifice in life is going to lose value year after year and you're poorer than before. Inflation is like getting old. It just happens to you whatever you have and whatever you do. So knowing that you will get older is no good reason to not have or not do anything. The second consideration, and I strongly believe in this, is that inflation on investments is like operational costs in a business. When you start a business and you're alone, it's just you and what you sell. So you're most likely going to have a really high net profit margin. You're selling a product for like $100, you have $40 costs, so you're earning 60%. But when your business grows and you start having staff, machines, advertising costs, your profit margin is going to get thinner and thinner. But the absolute value that you pocket is higher and higher. So say that you invest only for 10 years, inflation is going to account for 25% of your portfolio, but you already earned 65% on your investments in total. Now you keep investing and it's 30 years. Now the inflation accounts for 58%. Yes, but you're 350% over what you'd have without investing, with a total earning of 1.4 million. And considering inflation, you still have $742,000 compared to $164,000 that your savings would be worth without investing. If you invest for 100 years, which sounds crazy, but it actually happens when you give your portfolio to your children after you die, and they keep investing, inflation is crazy high and it's 95% out of your portfolio value. But still, after considering inflation, you have a buying power of $126 million. So just like operational cost of a company, the growing percentage, the bigger and more complex the company is, inflation is going to grow in percentage to your portfolio the longer you keep investing. But the absolute value you're going to achieve is still extremely positive compared to not investing. Alright, the last detail I want to show you is this simplified reverse calculator here. This is what you use if you know your goal and how long you want to invest, and you want to find out how much you should invest per month to reach that goal in that period of time. So with an initial capital of $1,000, if your goal inflation adjusted is 1 million and you have 35 years of investing in front of you, you need to invest $733 per month. Your real portfolio will be $2.8 million, but considering inflation, its buying power will be like having $1 million today. We can double check here with $1,000 initial capital, $733 monthly contribution, 35 years, and we achieve a portfolio value of $2.8 million or $1 million after inflation. I hope this video was useful for you. If it was, download the free file from the link in the description below and subscribe to the channel for more videos like this. I wish you a great day, everyone, and as always, I'll see you in the next video. Ciao!